It's been a series of riveting panels. The last one on investing. I'm a huge proponent of investing abroad, although I joked with some of our friends in Calgary on Tuesday that if you took the top 10 oil-producing nations by reserve around the world, Canada might be the only one you'd want to take a vacation in. But against that backdrop, we're faced with pretty volatile markets these days. That's the context of this conversation. And when you're faced with a volatile market, it probably makes sense to include some alternative investments in the portfolio, and that's going to be the context behind some of this conversation. Delighted to be flanked by John Wilson, Barry Allan, Frank Maeba, and Tom Holliday from right to left. Really a strong panel, and we'll talk about alternative investments and volatility within the context or the backdrop of a $2 trillion global alternative investment industry that's hit its recent high water mark after sort of post-crisis levels. In Canada, we're privy to about 300 fund managers in the alternative space, running roughly $30 billion in assets. And alternative investments are arguably the best kept secret in Canada. Canadians have exposure to alternative investments across the board, whether it's through direct subscription or it's through leading pension funds and family offices. And in our travels at the bank, where we talk to a lot of pension funds and sovereign wealth funds and family offices, we see the same themes emerging in these conversations, where people are really looking for you to check the boxes in terms of absolute return, and that's always the first question, diversification, transparency, the ability to conduct some pretty invasive due diligence, risk architecture, liquidity, agility, and within that context, I couldn't be framed by a better panel. The little last footnote I'll bring up before I end my soliloquy here is that if I was to take a cross-correlation matrix of this basket of managers, it would probably ring in at about 0, yet the return profile individually and in aggregate is really resoundingly positive. So that's a little bit of a hat tip to some of the outstanding results that we've seen in the alternative investment community. There's a KPMG paper that came out just a little while ago that speaks to that as well, and that it's sort of a statistical proof in a sense that the right managers can do very well with agility in this market. So with that, maybe what I'll do is I will ask each of my friends to my left to, for those of you who are not familiar with them, to introduce themselves and their mandates and their individual investment theses. Maybe John, starting with you.
All right. Thanks, Claude, and welcome everybody. I'll be brief because we've got lots of issues to go through. I'm with SPROTT Asset Management, and most of you would probably be familiar with the history at SPROTT and Eric, our founder. And he, for the last several years, has had a very macro-oriented view of the landscape and has expressed that largely through a view that the debasement of the monetary system globally would lead to an asset inflation type of outlook that would primarily and mostly benefit the precious metal space. So he's obviously made a lot of money for clients with that outlook over the last several years, and we have many funds that continue down that path today. My mandate is somewhat different. I share the same outlook in terms of where we ultimately end up. However, that type of outcome, it gets expressed in many ways. It doesn't have to be just precious metals. And if you look at it historically, we believe over the longer term, equities will be inflated as well. And our job is to put clients into that asset class in a way where they can handle the volatility, because we also believe that the volatility is not going away. And we can talk a bit more about this as we go through the session. I don't believe it's going away this year, next year, or this decade. So my strategies are primarily equity-oriented. We do use options to manage the vol and take advantage of it in certain instances. That's what I do.
Great. Barry?
Yeah, well, I'll just give you a brief rundown on MARRET Asset Management. It's a firm that I founded 12 years ago. We've roughly $6.5 billion in assets. It's about 75% long only or 70% long only, and the remainder are long short or hedge funds. We're primarily corporate debt specialists, high yield and investment grade. And whether we're in a long only or whether it's a long short portfolio, we believe strongly in producing low volatility, absolute return type of mandates. And I think that's particularly important these days because if you look at countries that go through sovereign debt issues, that their bond markets and stock markets move from being negatively correlated to positively correlated. And I think that's probably going to be with us for the better part of the next 12 to 18 months and will lead to a lot of volatility. So.
Hey there, I'm Frank Maeba. I have over 17 years of macro trading experience, mostly on the derivatives and option side. Last year, my partners and I launched BRETON Hill Capital, of which I'm a co-founder and a managing partner. And we did that with the backing of one of the larger U.S. pensions in North America. BRETON Hill Capital is a macro trading fund, so we pretty well trade everything, equities, FX, commodities, and some rates. One of the things that we do is we're pretty agnostic about how we make money. So we can be opportunistically long or short across markets. And one of the things that as John and Barry have alluded to, in these kind of volatile, swinging markets, I think you really have to be able to tactically shift your capital towards opportunities where you're going to be rewarded, and that's basically what we do.
And Tom?
Best for last. My name's Tom Holliday. I'm with Titan Advisors. I'm a co-founder and CIO of the firm. Titan Advisors is a $3.1 billion hedge fund of funds located right outside of New York City. We predominantly focus on two main strategies at our firm, long-short equity and macro. They complement each other very well from an exposure and a correlation standpoint. We also tend to favor managers that are small to mid-size and managers that employ strong fundamentals but with active risk management around their strategies to protect in the types of markets we've discussed here today.
Thanks. And Tom, I might just actually pick up on your introduction. You know, you mentioned that you have a focus on, let's call it emerging managers. And emerging managers defined in the U.S., it's probably reasonably large, I'm going to guess. What would be the range, roughly, that you're looking at in notional value?
Yeah, sure. So the average assets for a manager at Titan is about $800 million. We have a dedicated fund at Titan. It's a Titan Emerging Manager Fund, which is really the product we put these emerging managers in to start with as we gain comfort with them. The average AUM of a manager in that product is probably about $100 million. On average, we'll invest anywhere from startup up to maybe $200 or $300 million. But on average, it's about $100 million when we first invest. Obviously, to make it into our core products, they have to exhibit some growth both in the infrastructure and their assets. We have to have some degree of track record that we feel comfortable that they've been able to manage risk, and then we'll bring in our main products at some point in time after that.
It's great. And Tom and I were talking briefly last night about right-sized opportunities. And I would take that as a segue I've created myself, into Canada being potentially a right-sized market. To put the Canadian alternative investment market in context, we've got basically 15% of managers running over $100 million. So it's still very much in its infancy here, but we could argue that there are tremendous opportunities. I want to get back to your portfolio construction process, Tom, but before that, maybe I can ask, kind of John and Barry and Frank from a slightly more single-track or multi-strat manager perspective, which factors are driving your most bullish and bearish ideas? Which market signals, issuer-specific data, macroeconomic data influence your decisions? And can you take us through your investment process and maybe also the timeline, what your investment horizon looks like and if it shifts? And John, over to you.
So how much time do we have? So I'm going to be brief again, so my colleagues have a chance to answer that one. Wow. I guess, the world that we're in and we're likely to be in for quite some time is, we were talking about this before the panel started, was, the difficulty that I think everyone is having, and the challenge really, is that the catalysts that are going to create outcomes that you're trying to predict are largely policy-driven, which means predicting outcomes and behavior of individual policymakers around the world who may or may not even be in office, 3 or 4, 6 months from now. and who may or may not even do what they've sort of indicating that they might do. So that by definition means that your ability to be tactical, which Frank mentioned, and be very active, and have active risk management, which Tom mentioned, are absolutely critical, or you will get your head handed to you. And I don't care if you're primarily long or short. Things can change overnight, and it'll gap open on Monday morning or gap down Monday morning, and you won't get a chance to adjust after it happens. So that's sort of the context of how we look at the world that we're in. The time frame, because of that, is compressed. I don't believe you have the luxury of looking out 12, 18 months and making an investment today for that time horizon, because inevitably, and the history has been and will, in my opinion, continue to be, that unfortunately, when these policymakers do get in a room to try and make a decision, which is generally under crisis, the question they're asking themselves is, what is the minimum we can do to get back out of this room? Not what do we need to do to make us never come back in the room, which are two very different questions. And so as a result, we end up back in the same or different, bigger, worse problem 6, 9, 12 months later. So we're very focused on almost, I would say, 3-month windows in terms of risk. We are very aware of where volatility is, and I'll give you an example. It seems crazy now, but 3 or 4 weeks ago, implied and historical volatility was at a 5-year low, which seems crazy, but it was. So, I guess what I'd say is, at a broad perspective, we're looking at these issues being macro-driven. We're looking at them coming at us well within a 1-year window, and we're very focused on remaining whole so that we can take advantage of the next round of complacency or volatility. So there's a period where you can see there's a fat pitch and take advantage of it, and there's a period, which I would argue we're in, where the outcomes are too binary and it becomes very difficult to lay out a lot of capital one way or the other, and you just want to batten it down and ride it out till you wait for the next fat pitch. And that's kind of my view of the world, and I'll pass it on to Frank.
Okay, well, I'm going to answer that question kind of in 2 forms. The first 7 or 8 years of our lifetime in MARRET, we were primarily credit analysts. We made money by directionally trading credit spreads and doing something called capital structure arbitrage, where it would be long debt and short equity of various companies who were in kind of special situations. That process was designed to create kind of default free yield, where we would hedge out the default risk by being short the equity of the company and capture the excess yield. Since 2008, we've had to adapt our strategies to become much more macro, because the world has become more macro. Correlations have risen dramatically. The correlation between debt and equity of companies has actually broken down quite a bit, and the fact that the correlations within high-yield debt markets, there's much less differentiation between good credits and bad credits to do that. So now we're in much more of a macro environment. We really believe that, as I said, we're in a sovereign debt crisis. We need to solve that before we can revert to what we'll call more normalized markets. And I think our process has focused much more on the volatility and correlation, and more so on the spread differentials is what's happening in the rate markets more than the credit markets. So I think we're going to be in this for a little while, maybe not as long as a lot of people believe, but we think that you're going to see some solution in the sovereign debt crises in the next 12 to 18 months, but it's going to be kind of one hell of a ride during that period. So,
Barry, just to pick up on that point briefly, volatility used to be crisis-driven, fair to say, and now it's kind of a constant. and sovereign debt is the overarching issue, and you say that hopefully we come out of it after a bit of pain in 12 to 18 months. What are the catalysts that are going to lead us to come out of it? Like, is it basically, are they as simple as people will be working longer, entitlements will be lower, people will ratchet down expectations, or are there other macro factors at play?
Well, I think all those things are going to happen. If you look at the U.S. particularly, if you included the present value of unfunded entitlements, their debt would be $80 trillion with a $15 trillion, or their liabilities would be $80 trillion with a $15 trillion economy. That would be dramatically worse than any other country in the world. Greece or Japan, they would be nothing compared to that. So obviously those things aren't going to happen. Those entitlements aren't going to be